Welcome back to the Daily Crypto Roundup. Bitcoin is sitting on a knife edge right now with a potential supply shock building under the surface. XRP is quietly entering what analysts are calling a textbook accumulation phase. Ethereum whales are pulling hundreds of millions off exchanges, while institutions are circling staking products. At the same time, the SEC appears to be softening its tone on crypto regulation, and Binance has just launched AI-powered trading tools that could change how retail interacts with the market entirely. So today is not just another slow news day. It's one of those moments where multiple narratives are quietly aligning beneath the surface. And if you're paying attention, you can start to see where the next major move might come from. Let's start with the prices. Bitcoin is showing clear signs of a potential supply shock. Now, when we talk about a supply shock in crypto, what we're really talking about is a situation where available coins on exchanges start drying up, while long-term holders refuse to sell. That creates a squeeze, because if new demand comes in, there simply aren't enough coins available at current prices. Right now, on-chain data is showing exactly that. Exchange reserves are falling. Whale wallets are accumulating. Long-term holder supply is increasing. And perhaps most importantly, coins that haven't moved in over a year are continuing to grow as a percentage of total supply. This is exactly the kind of structure we saw before previous major moves. Analysts have been pointing this out quietly over the past few weeks. Julio Moreno from Crypto Quant has highlighted that long-term holder behavior is becoming increasingly dominant again, which historically precedes upward price pressure. Meanwhile, Glassnode data shows that the amount of Bitcoin held on exchanges is approaching multi-year lows. What that tells you is simple. The people who own the most Bitcoin are not interested in selling it here. And that's important. Because price is ultimately driven by supply and demand, not just sentiment. But here's where it gets interesting. Despite this bullish underlying structure, Bitcoin is not moving. And that's where the second major narrative comes in. Bitcoin is currently stuck in a low volatility range, and analysts are warning that a move towards $65,000, or even below, is still on the table. This is what we call a compression phase. The market is essentially coiling. Volatility is dropping. Price is moving sideways. And traders are becoming increasingly frustrated because nothing is happening. But historically, these are the moments that matter most. Because compression leads to expansion. You don't stay in a tight range forever. Eventually, something breaks. And when it does, the move is usually aggressive. Some analysts are leaning bearish in the short term, pointing to macro pressure. Higher interest rates, delayed Federal Reserve cuts, and general risk-off sentiment are all weighing on crypto. Goldman Sachs recently pushed expectations for rate cuts further into the year, potentially as late as September. That matters because liquidity drives crypto markets. When money is cheap, crypto tends to perform. When money is tight, risk assets struggle. So what you've got right now is a clash. On one side, you've got bullish on-chain data showing accumulation and supply tightening. On the other, you've got macro pressure keeping price suppressed. And when those two forces collide, the result is usually explosive. Now let's move to XRP, because this is one of the more interesting setups in the market right now. XRP appears to be entering what's known as a Wyckoff accumulation phase. If you're not familiar with Wyckoff, it's essentially a model that describes how large players, institutions, whales, smart money, accumulate assets before major price moves. The pattern typically involves a long period of sideways movement, low volatility, and gradual absorption of supply. Sound familiar? That's exactly what XRP is doing right now. Price is not breaking down, despite a lack of hype. It's not pumping aggressively either. It's just sitting there, consolidating, absorbing liquidity. And that's often how big moves begin. Analysts have been pointing out that XRP's structure is becoming increasingly constructive. Support levels are holding, volume is stabilizing. And more importantly, there are signs that larger players are positioning. But the real catalyst here could be Ripple's reported $750 million buyback plan. If this plays out as expected, it could significantly reduce circulating supply, at least temporarily, and provide a strong psychological boost to the market. Buybacks are a powerful signal. They tell the market that the company behind the asset believes it's undervalued. They create artificial demand, and they can act as a trigger for momentum. We've seen this in traditional markets countless times, and crypto is no different. So now you've got XRP sitting in accumulation, with a potential supply catalyst on the horizon. That combination is worth paying attention to. Now let's shift to Ethereum, because this is where institutional narratives are starting to build again. Ethereum whales have moved over $150 million off exchanges recently. And this is one of those signals that you don't ignore. When large holders withdraw funds from exchanges, it typically means one thing. They're not planning to sell anytime soon. Coins sitting on exchanges are liquid. They can be sold instantly. Coins held in private wallets are usually being stored for longer-term positioning. So when you see large outflows, it's generally considered bullish. But that's only part of the story. The bigger narrative forming around Ethereum right now is institutional staking. There's growing discussion around the possibility of Ethereum ETFs that include staking mechanisms. If that happens, it would fundamentally change how institutions interact with Ethereum. Instead of just holding the asset, they would be earning yield. And that's a completely different proposition. Because now Ethereum isn't just a speculative asset. It becomes something closer to a yield-generating instrument. That's extremely attractive to institutions. Analysts like Matt Haugen from Bitwise have suggested that staking could become one of the key drivers of institutional adoption over the next cycle. The idea that large funds can hold Ethereum and generate passive returns aligns much more closely with traditional finance models. So what you're seeing here is a slow shift in narrative. Ethereum is moving from being just another crypto asset to something that sits closer to the infrastructure layer of a new financial system. Now let's talk about Binance, because this is where things start to get a bit more futuristic. Binance has launched AI-powered trading tools designed to help users manage portfolios and execute strategies. And this is a trend that is not going away. AI and crypto are converging. These tools are designed to analyze market conditions, identify patterns, and assist with decision-making. For retail traders, this could lower the barrier to entry significantly. But there's a flip side. If everyone has access to AI tools, the market becomes more efficient and potentially more competitive. Alpha becomes harder to find. So while AI tools can help, they also raise the level of the game. And that's something traders need to be aware of. Now moving on to stablecoins, because this is a story that doesn't get enough attention but probably should. Circle, the company behind USDC, has seen massive growth, with reports of valuations or stock performance surging dramatically. Stablecoins are quietly becoming one of the most important pieces of the entire crypto ecosystem. They're not flashy, they don't pump 10x overnight, but they are essential. They act as the rails for trading, payments, and liquidity. And increasingly, they're being integrated into traditional financial systems. What we're seeing now is the early stages of stablecoins becoming a core part of global finance. And if that continues, companies like Circle are going to be right at the center of it. Now let's talk regulation, because this is another key shift happening right now. The SEC appears to be moving toward a more measured approach. Instead of blanket enforcement and aggressive crackdowns, there's growing discussion around what's being described as a minimum effective dose of regulation. In simple terms, that means regulating just enough to maintain control without completely stifling innovation. That's a big change. Because for years, the narrative has been that regulators are hostile toward crypto. If that starts to shift, even slightly, it opens the door for more institutional participation. And markets tend to move ahead of these changes, not after them. Finally, we need to talk about security. Because while all of this bullish narrative is building, there are still real risks in the system. Recent reports have highlighted vulnerabilities ranging from hardware exploits to platform-level security issues. And this is the part of crypto that doesn't get enough attention until something goes wrong. Security is still one of the biggest barriers to mass adoption. If users don't feel safe, they won't engage. That's why tools like hardware wallets, secure storage, and proper operational security are so important. And it's also why companies operating in this space need to prioritize infrastructure, not just growth. So when you step back and look at everything we've covered today, a clear picture starts to form. Bitcoin is tightening supply while price compresses. XRP is accumulating quietly with a potential buyback catalyst. Ethereum is building an institutional narrative around staking. AI is entering the trading space. Stablecoins are becoming financial infrastructure. Regulation is softening, and security remains the underlying risk. This is what a transition phase looks like. It's not loud, it's not explosive, it's subtle. But these are the phases that set up the next big move. Because by the time everything is obvious, the opportunity is usually gone. So the key question right now is simple. Are we in the calm before the storm? Or are we heading into a deeper correction before the next leg up? That's what the next few weeks are going to decide. But one thing is clear, the foundations are being built. And if history is any guide, that usually leads somewhere interesting. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.